Hey traders, in this lesson we will start learning about supply and demand zones. This theory in this strategy is based on smart money theories, and what they say is that the nature of the market is manipulative. Okay, so it says that there are strong hands in the markets that have a lot of trading capabilities. They are in profit. They can manipulate the price to some extent. They use powerful algorithms and so on and so on. These include institutions, banks, central banks, big traders, and so on. So it's not one thing. It's like abstract entity, strong hands, and then there are weak hands. They are liquidity. Strong hands use the weak hands to their advantage. They manipulate the public opinion, they manipulate the price, and they deceive these weak hands into some actions that are actually good for strong hands and bad for weak hands in terms of profit. So how it happens? So when the market goes in one direction, in some point of time we will see a pullback, okay? And this in a bullish market it will be some bearish price action. And this bearish, the smart money theory says that this bearish price action is caused by the action of the strong side of the market to deceive weak side into selling. Why they want this seller? So weak side sees that the market is going down, but we already know, yeah, that the structure is still bullish. But weak side don't know it, and they become liquidity, the sellers, for the smart money to buy, because if you want the market to move, you need a lot of orders, a lot of money, and this is what happens. So, and what's interesting, the smart money, they also participate in this move. And by the way, this is pretty simplistic explanation. Of course, it happens across multiple time frames, across multiple different sized positions, and what so on, and so on. But we just need to understand the very basic concept behind it, behind the nature of the market moves. So the strong side is still participating. They have their orders here, and at some point of time, the market will start a push up. And what happens is that strong side of the market, smart money we can call it, they have these orders that they use to push the market down, to facilitate this down move. They have these orders opened in drawdown here. And what happens is that market needs to come back here, and then they close these orders at break even, okay? And then this cycle continues. So the market goes up, but eventually, of course, on some specific time frame, the structure will be broken, because we will need deeper mitigations and so on. So this is the basic theory that stands behind the supply and demand zones. And in practice, what it means is that when you see a move down, you can not only separate the impulses, but you can find the last up moves before the down moves and the last down moves before the up moves. And this will be your zone. So what these zones tell you is that this was the last bullish price action, the last bullish manipulations before the significant breaks. And then we understand that this is a footprint of the smart money activity. We can use these zones in the future when the price comes back to it. We can use it as our points of interest, as our zones, and then we can wait for the reaction of the market and see what it does, and then find our confirmations that we will discuss later. Let's just quickly go through the market and see if it's true, if this theory is actually, at least, is presented in the history, okay? So let's maybe start with this price action. So what we have here, we have a break and we have the last down move, mitigated here and continued up. Then we have a break and the last down move. So now I will pick the zones more randomly, and in short, next topic of this video, I will tell you how you can refine the zones and make them more like more specific. But overall, what we have here, we have a reaction, more reaction, deeper mitigation. So mitigation is when the price comes back for closing the orders that are in drawdown from the smart money side, to close them at break even. Then we have more reaction, and then eventually these zones fail. This zone is failing. Market never reached back to this zone and just held the structure here. Held the structure, showed us a new break here. The last up move before the down move, mitigated it and continued down. And right away I want to tell you a difference, like a basic difference between classical break and retest, you know, or like trend line trading and support and resistance. So for me, everything can work, okay, everything can work, but this theory, it explains, in my opinion, the moves of the market better, and it aligns with the nature of the market itself better. And then you can pick more specific zones, because very popular situation for the market is the for example, break and retest strategy. So imagine a break, and then if you are trading like support and resistance, break and retest, you can say that this resistance became support, and now you are looking, for example, to buy from here. But what we can see is that we see deeper zones. So when the market starts to break this so-called support, we still can expect some reactions from the zone, and we can use it to our advantage. And if you will start to practice this theory, this strategy, you will see these patterns again and again, and they are really, really cool to trade. So we have this down move, and we have this down move. The market eventually breaks this zone and mitigates something deeper and shows us the reaction. At the same time, as I showed before, it breaks here and mitigates and gives us a new reaction. This zone fails again. We are not looking at any other time frame, but even on one time frame, you see the strong reactions, and you see how well it can be explained. And again, we will backtest, we will trade it, and we will see what happens. Again, a down move, and we come to specifically mitigate this last up move before the down move, which, by the way, reflects our pullback rule, as you can see. So this is a structural level. We now can explain why this move happened, why this reaction happened. Something like this we didn't see with this. So let me see if we had a break here. So yeah, actually we had a break here with this candle. We have a break which came, as you see, based on pullback rule from here. So we mitigated this zone and continued to new highs, a new structure, and then the structure started to be bearish and started to hold the bear side. So this is like a quick walkthrough and illustration of what the zones can be. Again, schematically, what you can take from this video now is that when you have separated your impulse, now you need to find the last down move before the up move, and you can use it as a better zone to trade. Because remember, we already discussed it, when you have a range, basically what you want from the market is a pullback and then continuation to a new high, and this zone tells you a better places to entry for your entry, and of course this will allow for better risk to reward and so on. So now let's talk about how we can refine our zones, and by refining I mean making them smaller. Because of course, when you look at the market, you can say something like this. So you can see this big move, and you can say, okay, so this is a big move down. So the last up move before this big move down was this one. And inside this zone somewhere, I can expect a reversal. And this is actually what happened. So you see, you have this up move before the down move, and the market took some liquidity here and then continued to the downside. And then what is your up move before this down move? Is it this one? Is it this one bigger? So you see, actually everything holds here. Everything holds here. These up moves, they hold. And the matter of fact, everything is correct. You can use these zones, but as you can see, it will be like really hard to pull good risk to reward from such huge zones in relation to the moves itself. And that's why we can say that there are different ways to view supply and demand zones, and different sizes of supply and demand zones. So when you see the market, you can say that you see this move, and your zone is this, like this big zone. But for me, of course, if I use the pullback rule, and if we say that this is actual impulse that came from this last pullback, then I will use this refined zone. See, in this case, this refined zone fails, and these bigger zones give a reaction. But at this point, it does not matter, because what we are doing here is starting to build some rules. And so the first way of refining, so again, you can use these big supply and demand zones for general understanding of what is happening in the market and what can you expect. But actually, for placing trades, there is a good rule that we can use, is that we can use the pullback as our refined zone. So for instance, yes, we understand that this is the move and this is the whole up leg before this down leg, but does it make sense to use it? No. And the nature of how the market moves allows us to use these pullbacks before the breaks as the zones. So what the first step is using the whole pullback, okay? And then second step is using some part of the pullback. You can use 50%, for example, or you can use the very last candle, so the very last up candle before the down moves. And this will already make your zone smaller, okay? Or you can use some unmitigated parts of the candle. So when I say unmitigated, I'm referring to imbalance. And what is imbalance is that when you have, for instance, this up move, and then, so this is your zone, and then the price leaves the zone without ever coming back to it. So what it tells us is that this manipulative move was successful, and now we are moving in one direction, leaving a lot of unmitigated orders here, because you see the price started to leave the zone and never came back, never tapped into this zone for mitigation. And that's why this zone considered clean, and we can, when we will mitigate it, we can expect some reaction from this. On the contrary, when we have a zone like this, so you see, we have an up move, the price started to go down, but then came back and mitigated it. We don't know if it mitigated everything it wanted or just a part of it. And that's why when the market comes back to such zones, we can say, okay, if it's mitigated, then what is the reason that the smart money is coming back to this zone? That maybe this zone will fail. So that's why zones with imbalance are better. And in this specific situations, we have this part, like this part unmitigated, or this up move. So this is like hidden CD. Maybe I will describe it a bit later. Yeah, and you see the market mitigated everything here and then started a move back down. So this is these are like the basics of supply and demand zones. And then of course you can even go on lower time frames and find some unmitigated parts on lower time frames, but will not touch it in this course. Okay, so let me walk through the chart. So let's and show you what supply and demand zones we could mark up based on what we discussed. So again, you can add a lot of different rules to supply and demand zones. For example, you can say that this zone took out this liquidity, this zone is high volume candle, and so on. Some of it we will discuss later when we will talk about the quality of setups, but some of it I'm discussing on one-on-ones. But anyways, even these concepts are pretty good to use already. So I will skip this range because it's like really not clear, but let's take this one. This is a range but not an impulse, you know, this situation of a real poor price action. But what we had there is a break, then a pullback, a new break with this small price action, and now we have a new break with this up move. So what are the down moves before the up move? You can tell that the bigger down move is this one. From this high to this low, the price moved down and then it went up. Right away you see it's mitigated, and then you can refine to this candle. So this last down candle combined with several here, so this is a more complex situation, gives you a zone which has this small imbalance. This is actually a fine zone. I mean, it's a fine zone technically, but combining with everything, with this bearish price action, with the low quality impulse, it's not good to use. But I'm just showing you some examples of how you can refine a zone. So the price created a new break of structure here with this candle, and now, so let me come back a bit in time. So now what zone can you use? The bigger zone would be this one. So you see the last pullback before the break is this one. So you can tell that your zone overall for this range is this one. Of course, you can say that there is this bigger down move, but again, if you will start to confirm such huge zones, it will not give you anything good, because you will confirm here, it will give you some entry and then fail. You will confirm again, give you some entry, fail. So that's why it's better to refine your zones, even that sometimes you will miss the moves, because sometimes the price will just mitigate these bigger zones, bigger structural zones, and just continue from there. So in this situation you have this root of the move which is mitigated, as you can see. So the price went down, then went up with this wick and went down again, so it's already mitigating it. And basically what it says is that this price action to us, what it says, that this down candle is the last, so combined with this one, so this is the last unmitigated portion of price action basically in this range. So we can look for confirmations there, and maybe depending on the time frame, it was your confirm here on lower time frames and it fails eventually. So now we have a new range. So let me clean the chart. We have this break of structure. Oh, we don't have it yet, sorry. So now we have a break of structure, and again we have some mitigated price action. Let's wait for a pullback. Okay, we have a pullback, and what we have here, we have a bigger zone, bigger up move. This is bigger up move before this down move. So yes, this is a zone, but it's mitigated, and actually everything here is mitigated until except some wicks. And by the way, the wicks are the zone themselves, because what the wick is if you think about what's happening here on lower time frames, is the price going up and then down again. So this is a zone with this imbalance. So you see, this is a wick. So actually what we can use here is only this wick. Let's see if it will work out. So yeah, it seems like the range is working out, but the zones are not mitigated there. So in this range, we can say that this is the bigger zone, and this bigger zone itself is mitigated, but higher candles have this imbalance, as you can see. So we can refine the zone to this candle and just expect some mitigation there, but it never happens. We just continue with the structure, and in this way you can mark up your zones and find your trades in them, and I will show you later how to find confirmations. Let's just quickly go through some zones here once again. Maybe let's switch the time frames. This is a nice wave, you see. So what we have here is this bigger move. We have a break, we have a zone which is unmitigated. So you see the zone unmitigated, mitigation, and it continued to the downside. This zone breaks to the upside. So this is an example when you see you have an up move and unmitigated zone lower, but the price mitigated this bigger zone. So this bigger zone will not be used usually in actual trading because it's just really risky. It's much better to use more extreme zones, and then you will have only maybe 2-3 losses there maximum before it confirms or invalidates. And then what we have this break. Sorry. We have this break that comes from these zones again. By the way, this zone at the time of the creation of the move is unmitigated. The price mitigates it, creates a new break, then goes a bit deeper below, mitigates some part here, and continues to the upside. This is a nice example. So we have a new break of structure here, by the way, you see. So this is not a break of structure. The break of structure comes from this candle. And now we have this last down move, which is in itself a pullback before the break. A really nice imbalance. Clear mitigation here, and then creation of a new break from this zone. Then the zone started to break. Maybe we go for deeper mitigations, create new breaks. This is another example of when the deeper zone does not get a mitigation. So what we have a break, and now we have a very big zone, which actually, so we have a very big zone which gets mitigated, and this big candle gets a mitigation. But if you want to use like 50% or this part of this candle, you will not get a mitigation there. And basically that's it for supply and demand zones. You will see much more examples further in the videos.